Hello, hi everyone. Good evening to all of you. Thanks for joining me here today for this session of an online webinar. So I understand it's again dinner time right now. So if you are actually having your dinner, just feel free to continue eating and just sit back and join us. So if not, if you are traveling or on your way home from work, just feel free to just tune in as well. So for today, right, I'll be covering on Forex trading, and we are looking at an introductory session to Forex trading. So we're covering more of the basic and foundation of what you need to know before you start trading Forex. So primarily we'll be looking at, how to calculate profit and loss for Forex and some of the common strategies that people use for trading Forex and how you can apply them on the trading platform. Okay, so before we start, right, I just wanted to give a very quick introduction about myself. So anyway, my name is Ethan. I'm the education lead here in the IG Singapore office. And prior to joining IG, right, I was in Philip Futures, another local brokerage who has recently rebranded to Philip Nova. So primarily, I've always been more of like an account managerial role and on the business development side of things. So here in IG, I'm focusing a little bit more on delivering content to help to value add clients, so that we are able to help you to kickstart your trading journey with us. Okay, so lesser about me and just some nitty gritty that I'll need to cover here, which is on the webinar disclaimer. So just take note that any form of advice that I happen to give today is not does not constitute an investment advice. So if I happen to provide any form of direction for the trades, right, in my examples, please just take note that it is mainly for educational purposes. It is mainly just an example. Please do not treat whatever I say as investment or trading advice. Okay, so if you're joining us today, I'm assuming that you are new to Forex trading and you may have been trading in other products like stocks or shares or even indices or commodities. So very happy that you guys are able to join me here today for this session on Forex trading. So a little bit of what we will be covering today will be the basics of Forex, leverage and calculation for Forex positions, and how we can apply basic TA to FX trading. And of course, towards the end, we'll talk a little bit on position size and how you can manage your risk when you're trading. Okay, so without further ado, just let me dive right straight into the webinar proper. So when we talk about Forex trading, right, so these 5 letters Forex, right, is actually a term derived from foreign exchange. So it's the short form for foreign exchange. It's known as Forex. So essentially what this means is that what we are doing is we are actually converting one currency into another. Okay, so let's say if you have been traveling overseas, right? Let's say you're visiting Bangkok or even Japan, you will need to convert your Singapore dollars, right, to the local domestic currency, uh, to purchase their goods and services there. So what happens here is that you go to a money changer, you give them your Singapore dollars, they give you the currency that you want, and of course it is based on an agreed exchange rate. So when we talk about Forex trading, right? For Forex trading, what you're actually speculating is on the exchange rate. Okay, so you're speculating the strength of the currencies. Okay, sorry, before I proceed further, right, I just wanted to highlight that there is a question box on the control panel, and I forgot to do a mic check. So if you're able to hear me, right, don't mind just type in a yes on the question box. You should be able to find a section. Okay, so yes, I see a few replies coming. Thank you very much. So for today's session, right, actually, I want it to be a little bit more interactive as well. So if you have any questions along the way at any part of the presentation, just feel free to type in the question box as well. And from time to time, I will take a look and address them one by one. Okay, so moving on to the next slide. Okay, so when we talk about Forex trading, right, of course, there is a market that's trading this particular asset class. So the first one, right, we're looking at, of course, is the banks, right? So when we look at the banking industry, right, there is actually a interbank market. So what I mean by interbank market is that within the banks, right, they actually trade currencies directly within themselves. So there is this market within all the different banks where they are trading directly. And of course, right, the bank clients such as us, right, we also sometimes we do currency exchanges with them, right? So what they do is they help to facilitate some of the forex transactions for the bank clients. And banks also usually they have this speculative prop desk to make money, to speculate on forex. So they have these speculative trades as well. They do speculative trades from their own trading desk. Okay, so next, right, we also have the hedge fund or investment managers, right, who are trading forex. So for hedge funds, right, what they are trying to do is they are trying to make the best use of investors, right? So people actually put money in these funds, right, or invest in all these different funds. So this group of more educated and kind of a more, they have knowledge on the markets, right? So they know what to invest in for you. And essentially, it's mainly to help their clients grow their money. So for hedge funds, right, they also have speculative positions in forex trading. But if you notice, right, a lot of these funds, right, they do not only trade in the domestic market. So let's say if you're investing money in a Singapore hedge fund, right? Of course, they don't just primarily invest into the Singapore market. They could be looking into things like the US or other global markets. So to do that, they cannot actually purchase the equities with SGD, right? So what they do is that with their huge trading volumes and values of their trade, they also need to perform some form of currency exchange, right, to buy these global equities. Other than that, right, for different funds with huge currency exposures, what they may potentially do as well is to hedge these exposures. So example, if this fund has a lot of US shares, and the view is that the exposure for USD is too large. So what they want to do is they may want to have a short position in the US dollar in case that the US dollar weakens, right? Then they are kind of hedged. So that's what some of these funds do as well. Next, we have the business and corporation. So business and corporations, they also do forex. Primarily, if you look at the old school plantations or factories, right? So just a very simple example. Let's say we have a Japanese company, a tire company. They are looking to buy rubber from Thailand. So definitely, right, they need to change their Japanese yen to Thai baht, right? Because the Thai companies, they do not want Japanese yen. They want it in their domestic currency. So there's some form of forex there as well. And of course, businesses, they also use FX to hedge their exposures. And lastly, we have the retail traders, which is people like you and I. What they do is that what we are trying to do, in fact, is that we are actually trying to make money, right, using forex, right? So that's what many of us try to do. And a few of us, maybe we have a lot of exposure in certain markets, let's say in the US dollar. So we may also look to use forex trading as a to hedge our currency exposure. Okay. So in the question, I think there's someone who's saying they can't hear me. Okay, so I think you need to restart or choose the audio output, but I guess it's just one person. So let's move on. Okay, so when we talk about forex trading volume, right? The volume that this particular segment, this asset class is actually very huge. So if you think that the stock exchanges, right, in the US, let's say the New York Stock Exchange, Nasdaq, London, or even the Asian one like Tokyo, right? If you think that the trading volume of in the billions, right, is already monstrous, then you'll be amazed that actually the forex trading volume that's happening every day is even more monstrous. It's over 6 trillion. Okay, so the stock market volume is nothing compared to the FX trading volume. And when I say 6 trillion, right, it's actually a very huge number because 1 trillion is actually 1,000 billion. So it's over 6,000 billion of trading volume every day. And hence we can conclude that this is actually a very liquid market, right? There's a lot of different people, banks, retail, businesses looking to enter this Forex market. Okay, so when we talk about FX market being very liquid, right, and how important is it, right? Let's just first define liquidity. Okay, so when we talk about liquidity, it's actually the ability for a currency pair to be traded. And when we say traded, it is the ability to go long or go short on demand. Okay, so liquidity is very important because imagine today, right, if you have an apple, let's say a fruit, an apple, and you know that the value of this particular apple is worth $2, but you are definitely not able to convert this fruit, right, to cash immediately, right? You may be able to take it to the marketplace next day to sell it for $2, and it is still considered fairly liquid. But for FX, right, it can be easily accessed online and you can actually transact immediately. So this is actually a very liquid market. And there will always be buyers and sellers because of the sheer volume, right? And the banks, the businesses, those that you always find that there is actually a quote for a lot of pairs, especially the liquid pairs, as compared to some of the, let's say, the penny stocks, which are less frequently traded. Then you tend to see that the spreads are also usually wider. Okay, so when we say that the FX market is a liquid market, right, you tend to get better trade execution due to the sheer number of people trading this market. And when you get better execution, right, the spreads as well, naturally, it is a very tight spread. Okay, so all this liquidity, it impacts how quickly you can actually open your positions, you can exit your positions, how fast can you do that, right? And other than the execution speed alone, right, we also look at things like the large number of orders that the number of buyers queuing for a certain price, the number of sellers queuing for a certain price, and increasing the probability for a higher price that a buyer is willing to pay and a lower price that a seller is willing to sell. So all this translates to a better spread. And with better spread, is actually also for us, right, the retail traders, it is actually lesser risk also, because you know that you can actually exit the market anytime you want. Okay, and it's fairly liquid. So there's always somebody at the other side that's willing to take your position. Okay, so if you're new to FX, right, FX is 24 hours market and it's open for 5 days a week. So every day, right, from Monday to Friday, right, you're able to trade at any point of time. It's not like our domestic Singapore exchange, right, 9 to 5, and then after 5 the exchange is closed and you have to wait for the next trading day for it to open. So for FX, right, it is 24 hours for 5 days a week, and there are 4 main sessions for FX trading. So the first session will be the Sydney session, followed by Tokyo and the London and the New York. So 4 main sessions, and in this particular picture that I got from Baby Pips, right, it is translated to Singapore time. So sorry, so if you keep hearing me say Singapore, is because this webinar is hosted from the Singapore office. So if you are actually a viewer or audience from another country, just take note that today we are hosting it from Singapore. So how you can read this is that if you look at the Sydney, right, it means that the blue bar, just let me enable my pointer. Okay, so the blue bar, right, it means that this is Singapore 5 a.m. in the morning for Sydney session, all the way to 2 p.m., 1400 hours, it will close. Tokyo session is from 8 a.m. to 17. This is the cash market. And for London, right, we are looking usually, it opens at about 3 p.m. depending on whether there's daylight savings as well, and all the way to midnight at 12 a.m. And for US session, right, it is from 8 a.m. all the way to 5 a.m. Sorry, 8 p.m. Singapore timing to 5 a.m. So at the bottom part over here, right, you notice that this is the rough trading volume for FX. So if we look at the most volatile or active hours for FX, right, it is always between the overlap between both the London and the New York session, which is about 8 p.m. to 12 a.m. So during the night for us, right, for the people residing in Singapore, it's where usually you see that there is a lot of FX trades going on during these hours. Okay, so just take note also, it is not the most active for certain pairs. So it also depends on pairs, but most of the majors and popular pairs are very active within these hours. Okay. So moving on FX, right, it is also bi-directional. So what it essentially means is that there are more opportunities for traders to speculate this market, right? Because you have the option to actually go long or to speculate on a buy position. Or if you are bearish, then you can also sell the currency pair, or what it translates is to go short. Okay. So important thing is you are not restricted by market direction. So if you think that this currency pair, right, the strength is going to strengthen, right, for a particular currency, you can actually buy it. And if you think that it will be weakening in the future, you can just short the particular currency. Okay, so it provides you a lot of opportunities. You can buy, you can sell. You're not restricted as a single direction like traditional shares. Okay. So next we look at margin and leverage. So I think the first impression that I get from most of the clients, and especially the newer clients, is that if they are from a investing kind of background and they are new to leverage products, the first thing that comes to mind obviously is the risk, right? So usually when you hear things like margin trading or leverage products, it is usually associated with high risk. But I think if you understand this concept properly, right, and how it actually works, then you can actually manage everything very well. Okay, so to dive into margin, right, firstly, let's just look at both leverage and margin. So when we talk about leverage, it is the ability to get a larger exposure, more than the money you deposited to open the trade. Okay, I'll share a little bit more with more examples later. So just take note that what it means is that you are using a smaller amount of cash to control a larger exposure. So that's leveraging on your cash in your trading account. So the next that you hear that will be on margin. So margin is actually the amount of money that you actually need to open the position. Is the deposit requirement to open and maintain this particular leverage position. Okay, so to quote you an example over here. So let's say if you are looking to enter a trade and this trade, right, the value is worth $1,000. So that's the full value of the trade. Let's just assume it is Tesla shares, okay? So you're looking to buy $1,000 of Tesla shares, but when we look at a leverage trade, right, you don't have to come out with the full $1,000. So what you need is just a fraction of the notional value or the exposure. So in this example, let's say if the margin required is 20%, it will translate to $200 because 20% of $1,000, which is the value of your trade, uh, will equals $200. So what we mean here is that the margin required is 20%, and this trade, right, you have a 5 times leverage. So 5 times is because you're just putting 20%, and if you divide if you use $1,000 divide by 200, you get 5 as well. So it's 5 times leverage or 1:5 leverage, and the margin required is 20%. Okay, so that's how we understand this whole concept. And just to highlight, right, the profit and loss is always based on your exposure and not your margin. So although you deposit only, let's say, $200 to enter this trade, right? If there is a 10% movement in the underlying product that you are trading, so let's say your exposure is $1,000, a 10% upside movement will be $100 profit. A 10% downside movement for you will be $100 loss. So a 10% doesn't mean that you're losing just 10% of the margin requirement. The margin is just a number that the broker tells you this is the percentage that you need to enter this trade. Um, this trade, but of course your net gains and your net loss, right, is always based on your true exposure, which is the notional value or the value of your trade. Okay, so if you are still confused, just let me know. I hope I'm able to share it in a clearer way. But that's that for now. So just take note that when you're using a lesser amount of money to control a larger position, right? So it means that your profits are always amplified. But that is also the same case for your losses, right? So a 10% movement for this example will mean that with $200, you can actually get 50% gains to $300 because $100 out of 200, which is your deposit, is 50%. But of course, if it is against you, right, then this $100, right, is also amplified, right? Is against $200. So that's a 50% loss as well. But if you understand the concept that is based on exposure, then all these risks can be managed properly. Okay, so just want to highlight that leverage is a double-edged sword. So forex trading is always leverage. So rarely people trade forex with the full amount. Most of the speculative trades are usually trading on higher leverage when they talk about forex trading. Okay, so just a very quick recap of what we have covered so far. So in a nutshell, right, forex trading is basically just in layman terms, right, exchanging one currency to another. So what we are trying to speculate is the exchange rate. Okay. Next is the market participants. So we have the banks, the hedge funds, the investment managers, businesses, and of course retail traders like you and I. 4 main sessions: Sydney, Tokyo, London, and New York. So it's open for 24 hours for 5 days a week, and it's a very active and liquid market. Sorry. Forex trading is bi-directional, so more opportunities. You can go long, you can go short, depending on your view of the market, and it's leverage and traded on margin. Okay, so if you have any questions, please type into the question box. If not, please just give me just 5 seconds. Okay, so moving on to understanding forex pairs, right, and how it's quoted. So just take note, right, in forex trading, it is always quoted in the different currencies are always quoted in 3-letter code. Okay, so example, the US dollar is quoted in USD, the British pound is quoted as GBP. So Singapore dollars is SGD, and of course Australian dollar AUD, etc. So you get the idea. There is always a 3-letter code tagged to a particular currency. Okay. Uh, okay, I see a question on the example of leverage and margin. So I think at the end of the session, right, after I cover the slides, I will go into the platform and I'll give more examples on leverage and margin, so you can get a better idea on that. Okay. So I'll explain more into the pairs first. So when we talk about forex trading, right, the strength of a currency, right, it has to be against another pair. So you don't see forex trading as the strength of US dollar, the strength of GBP. So it's always the strength of US dollar against another currency, or euro dollar against another currency. And hence, in all the trading platforms we are looking at forex trading, right, there is always two pairs. Okay, it's two currencies, one pair, sorry. It's always quoted in pairs. The exchange rate is always based on a pair, and it is not always just like US dollar. What is the rate? So it's a rate against another currency, hence it's a pair. Okay, so to give you a better idea, so let's say in this example, right, we look at US dollar against the Japanese yen. This is a forex pair that is everyone can trade in. So when we look at this pair, right, you need to understand that the first currency quoted, right, is what we call the base currency. Okay. So when we trade forex, right, or when we say we go long or short on a particular pair, right, the action of buying or selling is always referring to the front currency, which is the base currency. Okay. So the second currency is what we call the counter currency, and an opposite transaction will occur on the counter currency. So what do I mean is that, let's say if we are buying this pair, so you don't just buy US dollar, you need to buy the whole pair, US dollar against Japanese yen. So when we go long on this pair, right, essentially what it means is that we are buying the dollar and selling the yen. Okay, so one side will be buy, you will be buying one currency, and the other side will be um the opposite action, which is to sell. So if you buy this pair, the action, right, always refers to the front currency, the base currency, and the second currency in the pair will be the opposite action. So conversely, right, let's say if we are shorting this pair, the dollar against the yen, right, what it actually means is that you are selling the US dollar and you are buying the Japanese yen. Okay, so you are exchanging US dollar for yen, or you are buying US dollar by exchanging yen, by selling yen. Okay, so that's what it means by when you go long on a forex pair, or when you go short. Essentially, we are dissecting to the different currencies, what you're actually doing with the currencies. Okay, so just a very quick question here. You can type in the question box to test your understanding. Imagine if you are bullish on the Japanese yen. So right now you think that Japanese yen will strengthen. So do you think you should buy this pair, the US dollar against the yen, or do you think you should be shorting this pair if you are bullish on the yen? Okay, so I'll just give you 10 seconds to type this in the question box. Okay, thanks. I see some buy, some sell. Okay, so what is the correct answer? Okay, the correct answer is to actually short the pair, short US dollars against the Japanese yen. So for the people who said to buy, right? So when we are shorting this pair, right, what it means is that we are selling the dollar and buying yen. So you have to understand that when we are buying a certain currency, right, we are speculating and holding that currency and hope that the particular currency will strengthen. So again, if you are thinking that the yen will strengthen, right, you should be selling your US dollars now and buying yen. So if your view is that it will strengthen, you should be shorting this pair. And if you are longing on this US dollar against the Japanese yen, right? What you are speculating on, or your main intention should be, is that you are thinking that the dollar will be strengthening, okay, instead of the yen strengthening. Okay, so moving on to the next section on the quotation. So one thing to note is that when you see a particular pair, right, there is always an exchange rate, right? So you need to know that this exchange rate is always based on one unit of the base currency. So you see that in a forex pair, there is a base. There's two currencies, right? A base currency and a counter currency, as we shared earlier. So what it actually means that if you see this particular um, forex pair right now, okay, the pound against the dollar and the exchange rate is 1.1826. So what it essentially means is that 1 GBP is actually 1.1826 US dollars. Okay, so to translate to layman terms, right, let's say if you go to the money changer and it gives you this rate, right, it means that if you want to buy GBP right now, you need to give him, for every dollar of pound, right, you need to give him 1.1826 US dollar. And of course, if you have £1 right now, right, you can actually exchange it with the money changer for 1.1826. So that is how we dissect what this number means. So just remember, it is always one unit of the base currency. So let's say if you see a certain pair euro dollar and you see a certain rate, it means that one European dollar, right, one euro dollar is actually worth how much USD. Or if you see like the USD against the Singapore dollar, it means that one US dollar is worth how much Singapore dollar. So just remember, the base is always one. It's always one unit of the base currency. Okay, so just another quick question to test your understanding further, just a quick poll. Um, if we see this rate right now, the pound against the dollar, right? So which currency do you think is stronger? Is it the British pound or is it the US dollar? Okay, so I see some answers that saying it's the GBP. I see some answers on US dollar. Okay, so the correct answer is actually GBP, because if you are able to use one GBP, right, to exchange for more USD. So essentially GBP is stronger because for every unit of British pound, right, you're able to get more US dollars. So just imagine in the context or local context, right, I think very commonly, if you look at, if you're traveling to Malaysia, right, if Singapore dollars, one Singapore dollar you can exchange for, let's say, 3 ringgit, right? And tomorrow, if one Singapore dollars you can exchange for 4 ringgit, right? We'll say that the Singapore dollar is stronger, right? So as long as the number is above 1, right? So 1 GBP, you can exchange for more US dollar. We will say that the pound is stronger, okay? So for those who said GBP, your understanding is there already. So for those who say USD, just take note again, the USD is not stronger because for every £1 that you want to change it, right, you need more USD to change for just one unit of it. Okay, so the GBP is stronger. Okay, so moving on, right, for Forex, right, there is this term called PIP. So what is PIP? PIP is the short form for percentage in point, and it's basically like a tick value. Okay, so it's actually the smallest unit of price movement for any currency pairs. Okay, so when we look at Forex trading, right, it's actually a lot of decimal places, right? So you tend to see that it is not always in a whole value, like $1 for $2, $1 for $3. It is always in, you know, a very long number, and in a lot of decimal place. So when we talk about a pip, right, the pip is basically the fourth decimal place in a currency pair. Okay, so if you look at this particular exchange rate, right, euro dollars against the US dollar, the exchange rate is 0.9951. So the minimum change for this fluctuation, right, it doesn't change it doesn't change by the first decimal place, right? So every time it moves, right, it moves by the fourth decimal place. So that's what we call by a pip. Okay, so just a very quick recap, right? When we see this quote, right, what it means is that just remember the base currency, which is the front currency quoted here, the euro, is when we see this quote, right, it means that one euro dollar, right? If you want to buy one euro dollar, you will need uh 0.99 US dollars. And if you have one euro dollar now, right, you can actually sell it for 0.99 US dollars. Okay, so that's how we read this exchange rate. Okay, so just a poll again to test your understanding if you understand this concept of a pip. If the euro dollar strengthens, right, from 0.9951 to 0.9957, how many pips do we say? Do we consider this? How many pips? So just leave 10 seconds for you guys to answer. Okay, so I guess it's fairly straightforward, right? So it's the fourth decimal place from 5.1 to 5.7, from 1 to 7, right? It is a 6 pip increase. So everyone got it right. Okay, so the understanding is there. So another thing to take note will be for the Japanese yen, right? So Japanese yen pairs are a little different from the traditional ones. So you tend to see that for the yen crosses, right, it is usually in 2 decimal places. It's not quoted all the way to 4. So for the yen crosses, it will be the second decimal place is 1 pip. Okay, so it is not the fourth, it's the second decimal place. And just to recap again, if we see this exchange rate, right, what does it mean again? It is obviously $1, right? $1 again. To read is one unit of the base currency. Base currency is the first currency you see in the front. 1 unit of US dollars, we are able to exchange it for 140.51 Japanese yen. Okay, so this is how we read this currency pair. So again, to test your understanding, if the dollar yen strengthens from 140.51 to 140.62, how many pips is this increase? Okay, so I'll just leave about 10 seconds again. Thank you. So again, everybody got it right. The answer is 11 pips, right? So fairly straightforward again. So it is just that instead of the fourth decimal place, we are looking at the second decimal place right now for the yen crosses. Okay, so as if the Forex world is not complicated enough, there is actually something called a fractional pip, or what we call like a pipette. So a fractional pip, right, is actually 1/10 of a pip, right? So just to highlight to you, if you are trading with other platforms, or if you are familiar with FX trading, you tend to see that the platform is not quoting to 4 decimal places. It goes to even a 5th decimal place, right, which is a 10th of a pip. Okay, so the pip is the 4th decimal place, and 1/10 of it will be the 5th decimal place. So we see things like fractional pips in Forex trading. Okay, so nothing too complex. Just take note that fractional pip is just 1/10 of a pip, and there is fractional pip because sometimes the spread, right, is not even 1 pip. So the spread could be less than a pip, right? So it is very cost efficient, and it's good for us, right? Because if the spread is less than 1 pip, it means that if you enter a buy trade right now and immediately you sell, right, the cost of trading is very, very low because it is a lot of decimals and it is essentially not too significant, right? So again, the question is, if let's say the euro dollar strengthens from 0.99515 to 518, how many pips is that? Okay, so I see some answers coming in. Yes, thank you. Okay, so it is actually 0.3 pips. So it's a little bit of a trick question. How many pips? It is not even a full pip. So it's 0.3 pips or 3 fractional pips. Okay, so just take note, it's just the 5th decimal place of a currency pair. It's a fractional. That's what a fractional pip means. Next, so again, Japanese yen is a little different, right? So it is the pip is the 2nd decimal, the fractional pip is the 3rd decimal. So just know that it's 1/10 of the pip. So again, from 515 to 520, right? How many pips is this particular increase? So just take note again, it is for yen crosses, right? It is just the 3rd decimal for um, yen crosses, right? It's third decimal place for fractional pips. Yeah, so all of you got it already. It is 0.5 pips or 5 fractional pips. So fairly straightforward. Just understand that there's actually a lot of decimal places. Just understand roughly what it stands for. Okay. So in the world of Forex, right, you notice that from our previous examples, there is a lot of decimal places, right? So no one exactly trades Forex by the dollar, right? So we don't speculate with, let's say, $10, because any increase or decrease in the decimal places, it is so far back, right? The 4th decimal place, the 5th decimal place. If you are trading $10 or $100, you don't really see a lot of profits or losses. So when we speculate Forex, right, there is actually industry, right, there are actually what we call the lot sizes. So to introduce you to lot size, right, the standard lot, right, or one lot, right, a standard lot is actually $100,000. Okay, so when we say that we are looking to enter one lot in a particular pair, right, to buy or sell one lot, what we are referring to is to buy $100,000 of the base currency, or to sell $100,000 of the base currency. So that's one standard lot. Okay, so if you look at a smaller trade, right, it will be a mini lot. So in a mini lot, right, it means that it's actually 1/10 of a standard lot. So it is $10,000. And of course, right now there is already micro and even nano lots, but IG don't offer nano lots. It is just way too small. So micro lots is the smallest that we offer. So you can go as low as $1,000 to speculate. Okay, of course, this is the notional value of the trade. And again, you don't have to come out with the full $1,000, which I will share a little more in the platform demo later on the margin and leverage example. So just take note that when we are buying a standard lot or buying a mini lot or a nano lot, right, when you're trading, right, this is what it means. The value is $100,000, 10,000, and $1,000. Okay, so when we talk about the calculation over here for the pip, right? So one pip is the fourth decimal place. So when we look at a movement, right, if you are trading a standard lot, right, any increase or decrease, right, one pip is actually $10 profit and loss. So how is this $10 calculated? Is basically 0.0001 multiplied by $100,000. Okay, so any tick movement, if you are trading a standard lot, any tick movement is actually $10 profit and loss. So if that trade is too big for you, right, then you can consider trading mini lot. So it's $10,000, and any tick movement, again, same 0.001 is actually $1. Okay, $1 profit and loss. So this is more friendly for new traders who are trying to explore the world of forex. So just think how these numbers are calculated is basically 0.001 multiplied by the respective trade values: 100,000, 10,000, 1,000, and $100. So any movement for standard lot is $10, mini lot is $1, micro is 10 cents, and nano is 1 cent. Okay. So when we are looking at the lot sizes, right, lot sizes are always referring to the base currency as well. So what do I mean is that, let's say if we are going to buy this pair, we are looking to buy a standard lot of the dollar against the yen. One standard lot is $100,000. Does it mean $100,000 of US dollar or Japanese yen? So it always means the first currency. So the action of buy and sell is always on the base currency, which is the US dollar in this example. And the value, right, 100,000, 10,000, or even $1,000 is always also on the base currency. Okay, so if you are going one lot on this trade, means you are buying 100,000 of US dollars. If you are shorting it, then it's 100,000 US dollar as well. Okay, so moving on, let's just look at an example of the quotation, right? So when we look at a particular pair, right, just now, right, the previous example, we see one rate, but that's not the case, right? Because in the FX market, you don't see just one exchange rate, because there are buyers, there are sellers. There is a current price that, sellers are looking to sell their positions. There's a buying price that people are willing to buy. So there is a selling price that sellers are willing to sell, and there are people queuing to buy at lower prices, right? Hence, you see that for any pairs that you are trading, there is always a sell and buy. Okay, so if we look at the sell side, right, it is actually the bid price. It's basically the price that you are looking to short. And on the other hand, there is a buy price, which means that this is the exchange rate that I'm willing to go long on. Okay, so this is the ask or the offer. So often you hear things like the bid ask spread or the bid offer spread. Okay, so the difference between the sell and the buy is what we call the spread. So the spread is actually kind of like the cost of trading, because if you enter a buy position right now, right, and you decide to immediately liquidate or close your trade, then you would have incurred 1.5 points of trading costs. Okay, so the narrower the spread, right, the tighter the spread, right, the more beneficial it is for us when we are looking to trade forex. Okay, so if this number is a very small number, then it's very good for us. If it's a very huge number, then it may be an illiquid market, or it's just not competitive. All right. So in FX trading, right, let's just look at a few examples of understanding how we can calculate profits and loss, right? So if you think about shares trading, right, it is always the same concept, right? So you have an entry price, you're looking to buy at a particular exchange rate, and when you exit, you also exit at another particular exchange rate. So we just need to count what is the difference between our entry and our exit, and then we compare this difference, right? and we multiply it by the lot size, we will be able to count what is our true profit and loss for the FX trade. Okay, so just to illustrate with examples to further elaborate on this. Example, we look at this pair, the British pound against the US dollar. Okay, so right now there is this quotation, right? There's a sell quotation, there's a bid price, there is an ask price. So example, we are sorry, example, we are bullish on this pair, right? So what it means is that we think that the GBP will strengthen against the US dollar. So we are looking to buy into this current exchange rate right now. Okay, so we hit on the buy button and that is the rate we got in 1.16731. Okay, and in time to come, right, we exited this trade at 1.16881. Okay, so the first thing we need to know is to find out what is the difference, right? Based on our entry and exit, we take both entry and exit, we just subtract, right, the difference in exchange rate, and we see that, you know, the calculation is 0.0015, right? So 0.0015 is actually 15 pips. Okay, so the profit and loss will again be based on your lot size. So if you are entering a very big trade, right, example, if you're entering 10 lots, right, then of course you will see a different profit and loss. But in this example, right, to calculate the profit for just one standard lot, and just to recap, one standard lot is 100,000. We take 0.0015, we multiply by 100,000. That's how we get a profit and loss of 150 US dollars. Okay, so one thing I wanted to highlight is that when you're trading Forex, right, the profits and loss, right, is always the counter currency. Okay, so any gains or losses is always based on the real currency, and I will show you why is it. Okay, so if we translate this again to a kind of like a money changer or a real life scenario, right? By executing this particular trade, what it actually means, right? What we actually did in the trading platform essentially was that we bought 100,000 British pound, right? And to buy this 100K, right, we actually gave the money changer 116,000 US dollars. Okay, 116,731 US dollars. And so we exchanged our US dollars, right? So we sold US dollars and we bought the British pound. Okay, so we bought 100,000 worth of units, right? So when we exit the trade, right, now we have 100,000 British pound. We exchange it back for USD. So right now our rate, right, we got it at better. We bought it at 1.16731, but now we exchange it for the rate of 1.16881. So with our capital of 116,731, right, we are able to get a little more, 116,881. And if we subtract it, right, it translates to 150 US dollars. So when we look at FX trading, right, the profit and loss is always the counter currency, because if you understand truly again on the direction of the trade and each individual currency, which side you are buying and selling, is actually basically like us to going to the money changer and exchanging one currency for another. So basically this is just the layman transaction, right, of a standard lot. Okay, so standard lot, again, just to recap, it is always based on 100,000 of the base currency, and mini lot is 10,000, micro lot is 1,000. So the profit and loss will be different over here, the calculation portion. So just take the pip difference, multiply by whatever whatever trade size that you entered, and you'll be able to get the profit and loss. Okay, so it's nothing too complex, it's just more of the understanding. Okay, so just another example again, a more localized context. So again, we look at the profit and loss, we look at the pip difference multiplied by the lot size, nothing too complicated. So this time, the Singapore dollar against the US dollar against the Singapore dollar. So if you look at this exchange rate, right, 1.39763, just to recap, what it means is that 1 US dollar is worth 1.3976 Singapore dollars. So right now, we are looking to sell this particular pair. So to sell, it means that we are looking to short the US dollar and buy Singapore dollar. So what we are speculating right now is that the US dollar will weaken and the Singapore dollars will strengthen against the US dollar, and hence we take this trade. Okay, so our initial exchange rate is 1.39763, but in the future, when we close out the trade, we closed it at a higher price, 1.39963. So the difference is 20 pips, but this 20 pip is not a profit. It is a loss, because when we are shorting this pair, right, we need the exchange rate to be lower than what we initially entered, so we can buy it back at a cheaper price, okay, and profit from there. But in this case, right, the exchange rate when we exit the trade was higher, so we had to buy back at a more expensive rate, and hence this 20 pip is a loss. Okay, so if we count again, for one standard lot, we take 0.0020, we multiply it by 100,000 for a standard lot, right? The value of the trade, we get a loss of $200. Okay, so again, to translate into layman terms, right, when we short this pair, what it means is that we are selling the US dollar for Singapore dollar. So right now, just imagine in your bank, right, you have 100,000 US dollars, okay? So you don't want US dollar because you think that US dollars will weaken. So you sell it to someone who's willing to give you Singapore dollars. And right now you're holding Singapore dollars because you think Singapore dollars will strengthen, okay? So you exchange 100,000 US dollars, you receive about 139763 SGD. And eventually when you close your trade, right, you're exchanging back again by buying back the US dollars now with Singapore dollars. So again, because the exchange rate strengthened, so you are spending a little more Singapore dollars to buy back the same 100,000, and that's how we get the $200 loss. Okay, so again to recap, standard lot is 100,000, and it is the front currency, and 100,000 is not referring to the SGD. The trade of a standard lot to buy and sell, one lot is always to buy or sell 100,000 USD. Okay, so I hope I'm not going too quickly. But I hope this is, because this is an introductory class and there's a lot of things that I want to cover. I don't think I have enough time also, so I'll be going a little faster. So FX trading, right, there are time frames and trading styles as well, okay? So due to this liquidity, right, and the sheer volume of the FX market, right, we can actually trade across a very short time frame as compared to like an illiquid stock, right? So when we talk about trading, right, there's actually different trading time frames and different trading style. So if you're looking at a short-term time frame, right, we have the scalpers, right? So scalpers, what it means is that they actually look to enter and exit the trade very quickly. It can be within seconds or within minutes. And what they try to do is to just scalp a little bit of the pips, right? So just to exiting the trade with very, very minimal profit target. But by doing so, their trade size is usually larger, right? So they enter a very big trade, and what they do is just to try to profit from very small movements, okay? So usually when we trade, right, we also look at a trend indication. So if you are a scalper, right, maybe potentially your trend, you are looking for a trend from an hourly chart, and your execution could be on a very short term. It's not even 5 or 15 minutes. It could be a 1 minute chart as well. So you're scalping based on a 1 minute chart. Next, we have the day traders, right? So day traders is similar to scalpers, very short term. So what they do is that if I enter the trade today, right, I don't want to hold the trade overnight. I will be exiting within the trading day. So let's say if I enter the trade during the morning, before I sleep, right, I will definitely want to exit my trade. I don't want to hold this trade past the next trading day. Okay, so that's what we mean by day trader. So again, very short term, again, they don't hold trades for too long. Next, we have what we call like the swing traders. So for swing traders, right, they are kind of medium term. So potentially they are looking for certain trends in the daily chart, but they don't execute based on daily. They execute on a lower time frame. Example, maybe the hourly time frame or the 4-hour time frame. So for swing traders, they are looking to hold their trades for longer term, not like scalpers and day traders. So it could be from days to weeks. And usually people do that because they have a day job, right? Like if you're like me, we are working, then we don't really have time to exactly monitor the charts, right? So potentially what we may want to do is to look at longer term trading strategies, medium term or longer term. So the last one, we have the position traders that actually hold their trades for a even longer duration, right? It could be weeks, it could be months. So they're looking for any indication of an uptrend, a bullish trend, a bearish trend from the weekly charts, and their execution will be on a shorter, on a lower time frame chart, such as the daily chart. Okay, so the interesting thing about all this different type of trading style, right, is that usually there are two main considerations. The first consideration would be your daily schedule, right? So exactly what your daily schedule is like. If you have a day job, if you have family commitment, then probably you cannot be doing scalping, right? If you have a day job, unless at night and you just want to trade the US markets for a short while. So you are looking to just stare at the screen, be very active, then probably that's possible as well. But usually if you have a day job or you have family obligations, then you should be looking into medium or long term. But that's just the daily schedule. The second one is more on your personality and your attention span, right? So if you don't have a lot of time to do trading and you can't commit a lot of your schedule, right, to just look at charts, right, then definitely short-term trading kind of style is definitely not for you, right? So you have to look into a different kind of strategy, or even be doing like swing trades or position trades. Although I know it sounds very obvious, right? It is quite common sense that if you have no time, then obviously you don't do short-term strategies, you look at longer term. But I think more often than not, it sounds obvious, but new traders are often excited to do day trading, because if you watch like YouTube, you watch other traders, a lot of them are just, doing very short term. But I think it is more of finding a trading style that's suitable for your own as well and your personality. Okay, so let's move on. So the next section I'll be covering very quickly on technical analysis on FX. Okay, so when we talk about FX, right, there's this kind of methodology that people use. This is what we call technical analysis. So basically what it means is that we are trying to predict the future price, right, by studying historical data. So in a nutshell, that's what it means. And things that we look will be such as the trend, the price, the volume example, and then we use indicators, right, to help us to make certain trading decisions. Okay, so when we talk about technical analysis, right, there are assumptions. So the first assumption is that the market discounts everything. Okay, so what it basically means is that all fundamentals, right, all known fundamentals would have been already factored into the price. So if you think in the aspect of, let's say, the shares market, right, so sometimes you notice that before any major announcement, right, the share price could have already surged up, and then no one knows what's happening, right? So what you see is that, wow, suddenly this particular price, let's say for Apple, it just surged up 10%, and there isn't any major news, nobody knows why. But it could be like certain people have insider news. I'm not saying that is for Apple. Just saying that for specific shares, there could be like people with access to news that is not um it is not published in the markets, right? So you could see that there are some form of like buying activity happening even before any news releases. But if you look at price, right, price will tell you everything, right? So if you notice that this particular share price has a lot of buying volume, a lot of momentum, right, so everything is reflected. So all the fundamentals, all known fundamentals have already been priced into whatever share price is quoting, right? So this is one of the assumptions. The all known fundamental, it has to be uh accounted already. Okay, so the second assumption for technical analysis, right, we say that the prices move in trends. So what this means is that prices are likely to continue a past trend, a previous trend, rather than to move erratically. And a lot of trading strategies applying on technical analysis are usually based on this assumption as well. Okay, so prices will move in trends and not erratically. So that's one of the assumptions. And the last one is that the history tends to repeat itself, right? So this is mainly attributed to predictable market psychology, which affects price in a repetitive nature. So we assume that, based on previous patterns, it will repeat itself. Okay, history will tend to repeat itself. So of course, if you are more of fundamental in nature, right, it's nothing wrong. It is just that there will definitely be critics who argue, right, that history, of course, uh, and in fact, it's not every time. It does not always repeat itself, and hence technical analysis is not accurate. Okay, and they will say that, the reason it works is because it is kind of like a self-fulfilling prophecy. And what this means is that because everyone is looking at the same indicators closely, right, and looking at the same levels, and there is this large number of people, right, that base their trading decisions on this same indicator. So it's kind of like a herd mentality. If everyone is looking, let's say, at the moving average, the EMA 200, and it is, everyone is just staring at this particular indicator, right? Then when certain prices break above or break below these levels, and then it pushes price in a direction, right? So this is kind of like a self-fulfilling prophecy, because everyone is just looking at the same indicator, the same things. So the critics will say that it does not usually repeat itself because of this factor, right? But today, not here to debate on this. We just look into the basics of technical analysis. Okay, so when we look at technical analysis, then of course it is more of understanding chart patterns, and to understand chart patterns, you first have to understand these things, right? So this is what we call is a Japanese candlestick. So I'll just touch very quickly on candlestick. So when we look at chart, right, it is usually there's like bar chart, line chart, and things like that. But usually, more often than not, you notice that people are looking at candlesticks because you can get more information as compared to a line chart. So when you look at a candlestick, right, you tend to see four pieces of information: the open price, the close price, and of course within the trading day, right, there is a low and a high. So what it means is that if the market opens at a particular price, this is the open price, and if it closes at a price higher, right, that is where you will see a green candle. And of course, within the trading day, right, it doesn't always open and closes at the same price. There could be prices breaking below the opening or even surging past the closing price. And hence you see these two lines. These two lines is what we call a wick. Okay, so it reflects the high and lows of the underlying asset you are trading. And if you see that it's a green candle, what it means is that the closing price is higher than the opening price. So exactly the same bar, right? The same candle, right? If you see a red, right, it just means that the price closed lower than the opening. And of course, you will see two lines again, the high of the day and the low. So a candlestick may not necessarily represent the price action for a trading day, because if you are looking at different time frames, example, let's say the 4-hour chart or the hourly chart. So what it actually means is that one candle is the whole price action for 4 hours or for the hour. So it depends on the time frame that you are actually looking at as well. Okay, so for candlestick, right, there are actually candlestick patterns also when we talk about applying TA. So the first pattern is actually what we call like a hammer pattern. So the hammer pattern is basically, you tend to see like a very small body with a long lower wick, right? So what it essentially translates to is that it is kind of like a reversal pattern, because if you understand that this is actually like the opening price over here, and prices within the day, right, it got pushed down all the way, but there was buying pressure back up and it closed higher. So what this translates is it's kind of like a bullish reversal pattern, and signals that prices is nearing kind of like a bottom of a downtrend. And by the time the market close, right, there are buyers that's actually absorbing all these selling pressures and pushing the closing price even higher, right? So uh, this is a bullish reversal pattern, and is usually kind of reflective for the bottom of a market in a downtrend. So if you see this particular candle when prices are going up, right, it doesn't really mean too much. But if you see that the previous candles are actually in a downtrend, this candle could potentially mean that it is near the bottom. Okay, so if you are going to go long, right, then potentially, right, you can actually enter and place a stop loss, right, just below the wick, right? And of course, you can also use this candle if your initial position was to short and you're riding a downtrend, right, and you notice that there is a hammer pattern forming, then this is potentially where you may want to scale out or start to take profits, because it can signal it's a potential reversal. Okay, so it's never 100%. Everything is probability and potential. So we always look at what happens to the price after. Okay, so again, there is selling pressure present, but buyers are also driving price back up. Okay, so again, potential bottom and reversal. Next, we have this pattern called the bullish engulfing pattern for candlestick. So what it actually means is that this is a two candle pattern. Okay, so you need two candles to see this pattern. And this bullish engulfing patterns, right, the first one, it will be a bearish candle, and the second one will be a bullish candle. So what it means is that the second bullish candle, right, the body, right, is covering or engulfs the whole bearish candle. And usually when we see this, right, it is more of a bullish kind of pattern. Okay, so we also look at the preceding candle. So we don't just look at two candles individually. We look at the price action before this bullish engulfing pattern happens. And if it's a downtrend, right, and there's a lot of bearish candles before, and then you notice that the next candle is kind of it closed and there was a bullish engulfing, then it means that there is a greater probability, again, it's never 100%, that it could be a potential reversal. Okay, so next, just the opposite of a hammer, we have what we call like a shooting star pattern. Okay, so again, you see that there is actually there's actually a lot of buying pressures up, right? So within the trading day, buyers pushed the price to a high, but eventually the sellers took control and the price went back down and it closed somewhere below. Okay, so when this happens, right, we know that there's a lot of selling pressure. This could be like a potential resistance, and if the previous candles, right, were bullish or the trend was bullish, then this is also a potential reversal. Okay, so it's just the opposite of a hammer. And if you see this in a downtrend, it doesn't really mean much. But of course, if you see that the previous price action was kind of in an uptrend, and you start to spot like a shooting star pattern, right, then it could actually potentially mean that there is a reversal coming. Okay. So next we have bullish engulfing previously. So now we have bearish engulfing. So again, it's the same thing. It's a two candle pattern. So the first one will now be a bullish candle, and the second candle will be a long red candle that the body engulfs the first green candle. So it can form anywhere, of course, but it will always be more significant if the previous price action was in an upwards trajectory. Okay, so it signifies that there's a peak or slowdown in the price movement, so potentially there could be a reversal as well if you see a bearish engulfing pattern in an uptrend. Okay, so let's move on to some of the common trading strategies that people do when they are looking to trade FX. So the first one, right, very commonly, even if it's not FX, if you are trading shares or commodities indices, right, often you hear people talk about things like trend trading. Okay, so basically what it means when we say that we want to trade the trend is basically we are looking to capture gains, right, through the momentum, upside momentum, right. It could be upside, it could be downside. So trend is not always one side. It could be a bullish trend. It could also be a bearish trend, right. So what we want to do is to just profit as much as we can from these trends. Okay, so to identify trends, right, usually what we do is that we can use indicators like moving average. But basically, one look you should be able to tell, because um, for uptrend, right, it's quite obvious. You will see that the lows are higher lows and the highs are higher highs. So when you see that the price action, right, there are higher lows and higher highs forming, right. So we can say that this particular underlying asset is in an uptrend. And uh, conversely, right, if you see that the prices, right, lower highs and lower lows, that means that it is in a downtrend. So trend trading is one of the strategies that people use to to trade FX. And for trends, right, although the example I show here is a daily chart, right, trends can happen in shorter time frames as well. So you can look for trends in, let's say, the hourly chart, the 4-hourly chart, or even the weekly chart, right. So trend can happen in any time frame. I just wanted to highlight that if you notice a trend on a shorter time frame, right, usually the higher time frame is the main trend, right? Because the shorter time frame is usually more noise. So if you happen to see like the 1 minute chart, right, is in an uptrend, right, you could notice that, or the daily chart could be in a downtrend. So the shorter time frame, as you dive into a shorter time frame, right, it gets noisier and messier. So as you look at price action in a more bird's eye view, right, from a longer time frame or a longer period, example daily chart, weekly chart, even monthly chart, right, and if you spot a trend, right, so those trends tend to hold better, right. Is in the grand scheme of things, that's how prices are actually trading. So for us, right, what we want to do is just focus on a time frame that matches again close to our schedule. So of course, if you are scalping, then you are probably not looking to trade too much on trend. If you're doing swing trades or position trades, then possibly you can look into trend trading. Okay, so it has to match with your schedule, match with your objectives. So when you look at trend trading, in this example, what I have here is moving average. So you can actually add certain lines, right? This is a moving average indicator. You can add it to your chart, and when certain price dips and retests certain moving averages, right? Um, then you can actually look to enter the trades. Okay, so upside for trend trading, of course, there's a lot of upside, because if you happen to enter a trend early, right, you can actually ride the trend, and the profits potentially is a lot higher. And you can also manage your risk using things like trailing stop. But of course, the disadvantages of trend trading, I would say, is that it is not as easy to trade trends, because a good trend doesn't happen too often. So you can be looking at charts every day, and you tend to see that there isn't much trend going on, or you could be already be late into the trend, right? So you don't it's hard to be, you know, the first mover in a trend. So I would say that it's not as easy as well. So the next one, we have range trading. So I think this is fairly straightforward, right? When we look at charts, right, many of times we tend to see prices ranging between certain support and resistance. So of course the concept here is that what we want to do when prices are ranging is we want to buy at support and sell at resistance, right? So it's just buy low and sell high, the concept. And our belief for range trading would be that the range will hold. So we enter a trade because we feel that when prices reach certain resistance, it will retrace back to a certain support level, and that's where there will be demand and buying pressure, right, and push it to resistance again, and there will be shorting again. Sellers will come in again to short at a certain level. So if your view is that the market, you know, is not certain on price action, and if it's currently ranging or consolidating, you can look to trade this range. And I would say that the advantages of trading range, right, it's uh will be on the risk management side of things, because the support and resistance are fairly obvious, right? Then you will be able to manage your risk, because if your belief is that this trend will hold, and if prices breaks the support and resistance, right, then that's where you will cut your losses, right? So of course, if you're buying at the support and you got it wrong, prices broke the support, then that's where you get out, right? Because the belief is wrong already. Your initial trade idea is invalidated. So it's very easy to manage your risk, and that's one. Um, Disadvantages of trend trading, sorry, not trend, for range trading will be that your upsides are always kept, right? So if your belief is that this range will hold and you're buying at support level, right, then the take profit is very obvious at the resistance level, and you can't really get uh, a, a very a very good amount of profits as compared to trend trading. So if you're trading within this range, then obviously if you're buying at the support, then you already know that this is where you want to sell, the closer to the resistance. And it's easy to manage risk when these prices break above the lows, right, of the previous support, then you can look to exit. So usually your risk parameters are fairly obvious. You know your trade plan very well, where to enter, where to exit, and you're just trading the range. Okay. So the last one many people do is trading breakouts. So when we are trading breakouts, right, it refers to when the price of the underlying asset, right, it moves above a certain resistance area or a support level. And usually it could be a start of a it could be the start of a new trend. But um, for breakout, what happens is that if it's a key support level, right, and imagine, like, let's say you're looking at Tesla shares, right? So you notice that Tesla share example, if it's trading at, let's say, in the past, let's say $800, right? And without any news, right, you tend to if you notice that the price action for Tesla starts to surge, right, there could be people with information that you don't have yet, and the price action is already reflecting that, right? Then there could be potential buyers coming in as well to join the momentum. Okay, so when certain resistance and supports has been broken, right, many will believe that the price will trend to the direction, and if people are trading this range, right, then it will also trigger their stop loss. So in this particular example, right, so let's say this was the previous range, and for people who are trading range, right, they could have a buy order here and a stop loss below the support, right? So if prices break below, right, it will trigger their stop loss. And for people who are trading breakouts, right, they will have a sell order ready, waiting for the price to break. And all this will translate into momentum, right? So stop loss trigger, new orders coming in, and you tend to see prices, right, um, start to trend towards the direction of the breakout, right? So it broke support, then prices tend to trend downwards. If prices broke above the resistance, it goes upwards. So breakout trading is one of the strategies as well. But one thing to take note, of course, is that this is a cherry pick chart. So there could be false breakouts as well, and we term it like fake outs. So it's not as easy also. So just wanted to highlight that this is one of the strategies that people are actually looking at. So the other one, right, will be, of course, like a channel breakout, right? So we notice that prices have been consolidating in a channel, and of course, if it breaks certain resistance again, you see that prices tend to trend outwards. So if you're looking to trade breakouts, potentially you could have a buy order that is above here. So when prices haven't broken this level, right, you already have an order to buy above this level. So when prices broke above this particular resistance, right, it will trigger your buy order and you can ride the momentum up. Okay, so this is what we mean by breakout trading. Okay, so now let's talk a little bit about risk management before we move on to the platform. So this is the last portion of the slides. So when we talk about risk management, right, it actually refers to the process of how we manage our risk. So when we talk about managing risk, right, few things we want to consider. So first thing is how much money are we willing to risk, right? So very straightforward. If you have a certain amount of money, you don't want to put everything to trade forex, right? You just want to try out maybe a small amount, or when you're trading leverage, you also don't have to put out a lot of capital. So this is one question you ask yourself. Firstly, what is the amount you're willing to risk? Second question you want to ask yourself when we are looking at risk management is the maximum loss per trade. Okay, so for every particular trade, we don't go all in, right, on the whole account balance on one trade. So we try to manage risk by position sizing our trades properly according to our account value. We try to have a cap on a maximum loss for every trade that we take, right? So in a way, we can sleep better as well, knowing that this particular trade, if it hits certain level, the loss isn't too big. Okay, so emotionally and psychologically, you'll also be in a better place as well. Thirdly, we also want to look at trading plan. So when I say trade plan, right, it is more of your entry, your exits, and your risk parameters. So basically, before we enter a forex trade, we want to ask ourselves what is the price we are looking to buy or to sell, and if we happen to enter this trade, right, where do we want to take our profits, or where do we want to take our losses? So it's a little bit different from investing, because let's say if you are buying shares and accumulating shares, right, you tend to do things like dollar cost averaging when the share price dips, right? But if you're trading FX and it's a leverage product, right, it is the losses can be very detrimental if it's in a downtrend and you refuse to believe that you are wrong, and you still continue to buy to try to lower down your average price or the exchange rate that you entered. So always good to have a trade plan and follow your trade plan. And the last one will be the position size. Okay, so this is where we learn today on how we specifically calculate. Previously we shared about lot size. So how big of a trade do we enter based on these risk parameters? Okay, so just let me cover that right now. Okay, so the first concept I want to introduce to you guys will be on what we call the 2% rule. Okay, so 2% rule is nothing too complex. So just take note that what we want to do right here is to limit every trade, right, to 2% of our account balance. So what it means right here is an example. If you have a $10,000 trading account, 2% will be $200, right? So of course, if you have a bigger account, you can risk more. If you have a smaller account, you shouldn't be risking too much, right, for every trade. So just assuming, let's say if your account size is, let's say, $1,000, then for every FX trade that you're entering, right, if we are using the 2% rule, then this trade you shouldn't risk more than $20 for this trade. Okay, so that's what it means by 2% rule. Okay, so of course this 2% is not a fixed thing. If you are stricter with yourself, you could give yourself like 1%. So every trade is just 1% of your account size. The stop loss or the amount that you're willing to risk is just 1%. It can also be below 1%. Or if you're less stringent, it can be a bit more flexible. It can be a bit more slack, right? To give yourself a 3% risk. But of course, this is always based on your risk profile. And more importantly, you're comfortable with the amount that you're willing to risk and sticking to it. But for today, I'll just be going through this using the 2% rule. Okay. So basically what we want to know using the 2% rule, right, essentially is how big of a trade should we enter. Okay, so let's say right now, if we say that we want to limit it to 2%, which is this previous example that we see, the first step is we determine the maximum loss that we can actually stomach based on our account size per trade. The second step is we need a trade plan, right? Because when we know the maximum amount of risk or the maximum amount of money we are willing to risk for this particular trade, we need to have a plan. So based on, let's say, the $10,000 account size, right? If we are willing to risk $200 for this trade, right? So we have a $200 kind of like a budget to work with. what is our trade plan? Are we looking to long the market? Are we looking to short the market? And where's our exit? Okay, so essentially this rule, what we are trying to do is we are trying to calculate position size so it does not exceed this 2% rule. Okay, to give you more context, right? So this is what we are trying to do. Okay, so if we have a trade plan, we are trying to find out, should we enter $100,000 one standard lot for this trade? Should we enter one mini lot, or should we enter 5 mini lots? So what we are trying to do is we are trying to know how much of the base currency to purchase or to sell based on our trade plan. Okay, so example, if you know that your stop loss is 60 pips from your entry and you have a $20,000 account, and based on the 2% rule, you have the flexibility to risk $400 for this trade, right? So clearly you already know your entry, you know your stop loss, your account size is straightforward, right? And you know that 2% of your account size is $400 right now. So how big of a trade should I enter? Okay, so this is what we are looking to calculate. Okay, so if you use this rule, right, again, let's say just a example, we have our own analysis. Okay, so our plan right now, we are looking to buy the euro dollar. Okay, so the euro against the dollar at 1.0500 right now, we have a target to close our trade in profit 60 pips away. So remember, 1 pip is the fourth decimal place, so 60 pip is 1.0560. So that exchange rate is our take profit. Okay, because we are looking to buy, so 60 pip is a better rate, right? A stronger rate, so it's a bigger number. And our stop loss right now is 30 pips below our entry. So we minus 30 pips from 1.0500, and we have a $20,000 account. So just to recap, step one, we determine our max loss. Okay, so right here, we determine that with an account size of 20,000, based on the 2% rule, that's $400 that we can risk. So we have also established our trade plan based on our own analysis. So we are looking to buy euro dollar 1.0500. 60 pips take profit would mean that the exchange rate, sorry, there's no dollar value here. It is 1.0560, 60 pips increase. Stop loss 30 pips decrease from our entry is 1.0470. So this is the order that we have. So this is the part that is tricky because we know our entry, we know our exit, we know our budget for this trade. So how big should we trade, right? Is it 1 lot? Is it 5 lots? So that's what we are trying to count, which is the position size. So the formula to calculate position size is we know our max loss, we divide by the risk we take per lot, then we will get the lot size. Okay. So to illustrate, I just wanted to highlight example. This example, we have a $400 budget to work with. Not exactly budget, it's the risk parameters. Our risk parameters, we have a $400 that we are willing to risk, and the risk taken per lot, right? So right now we are thinking that we are able to stomach 30 pips right now. And we know that one standard lot, 1 pip is $10. So if we have a 30 pips stop loss range, right, this means that it's $300. Okay, so if we take $400 of a loss that of a risk that we can actually potentially take, and our trade size is based on $300 per lot, right? If we divide it, then we know that we can actually enter a trade of 1.33 lots. Okay, so this is how we calculate. If you want an easy way, right, there's actually a lot of the position size calculators online as well. You can just Google and indicate your entry, your stop loss, and the amount you're willing to risk. And there are a lot of forex calculators that can count for you as well how big of a trade size you should enter. So this is the whole concept of risk management. Mainly it is not just putting a stop loss to the trade, because if let's say if your account size is $1,000 and your stop loss is $500, right, then it doesn't really make a lot of sense as well, because you're just risking half of your account balance on this one trade, right? So if you are referring to, if you want longevity in trading, right, then definitely you need to manage your risk. Okay, so you need to think about what is an appropriate trade size that I have to enter based on my trade plan, and this is the way that we can calculate. Okay, so the amount you are willing to risk divided by what is the number of pips multiplied by $10 per pip. So that's the value of the loss. We take that, we divide it, we get the number of lots that we should be entering based on our risk parameters and account size. Okay, so of course there are some trade trade-off is this: if you're looking at 2% rule, right, and if you think that you want to, if you put your stop loss too tight, right, of course you can definitely enter a bigger trade size, right? Because if your stop loss is just 10 pips and you can risk $1,000 for this 10 pip movement, then it means that you can potentially go into 10 lots, right? You can trade a very big size. But if your stop loss is, let's say, 100 pips away from your entry, and with the same $1,000, you will not be able to enter the bigger size. So if your stop loss is further away, you will only be able to enter a smaller trade size. Okay, so there are some trades-off to this, but again, there is more than that lah, because if your stop loss is too tight, right, then more often than not, you will be taken out by market volatility as well. So let's say if your initial direction is a buy direction, meaning to say you're looking for prices to strengthen, so you're buying first, and you got the direction correct, but before the prices went up, right, there is some volatility and it triggered your stop loss because your stop loss is just too near your entry, and you're just trading too big of a size. And eventually it went up. So you were right initially, but you didn't manage to get a good setup for the trade. So of course, if your stop loss is far, then you can better tank all this volatility. But again, your trade size will be smaller. Okay, so there are always trade-off. So before I flash this feedback form, right, I just wanted to do a very quick platform demonstration on FX. So just let me share my screen. Okay, so I believe you guys can see the trading platform. Just let me log in. Okay, so I think we have questions earlier on leverage and margin. And there is another question on currency conversion due to the nature of the trading account being SGD denominated. Okay, so just let me cover those questions now. Of course, if you guys still have questions, just feel free to type into the question box so I can address them right now as well. Okay, so just let me go into the trading platform first. Let me close all this. Okay, so this, what you're seeing right now is the IG trading platform. I'm using the desktop to show you. So what you're seeing is the desktop application for our web-based proprietary trading platform. So over here on the left-hand panel, right, there will be this asset class, FX. So if you click on it, right, you'll be able to see the different pairs that you're looking to trade. Okay, so as I shared earlier in the introductory part, right, that all FX are quoted in pairs. So you tend to see that, there are major pairs, there are minors, there are majors, there are minors for you to trade. To dive into an example, let me just click on this particular pair, the euro against the dollar. I'll add it to workspace and maximize this. Okay, just let me remove everything, all the indicators, so the chart is cleaner and easier to see. Okay, so this is just the chart. Okay, so over here, right, this is the trading platform. Okay, I'm on the hourly chart. Let me change it to a daily chart. Okay, so as I shared earlier, these are candlesticks, right? So there is always a body. There is a wick usually if there is a high and low for the particular time frame that you have selected. So right now I'm on a daily chart. So every candle is actually the price action that happened for the day. So a green candle means that prices open over here, the bottom of the body, it closed higher. You see two very fine lines over here, right? So this is where the lows of the day, and this is the highs of the day. And if it's a red candle, right, what it basically means is that prices open at the top here, it closed below, and again same thing, the upper wick is the highs and the lower wicks it will be the low. Okay, so this is the order ticket. So for this particular pair, the euro against the dollar, you can actually select over here the drop down whether you want to trade a mini contract or a standard contract. So like I shared earlier on the lot size, right, if you are going into this contract, right, it is actually means that one lot is 100,000. This is a standard lot. If you're looking to trade smaller in a smaller size, you can actually select this mini contract, the euro dollar mini. Okay, so there is no difference at all in terms of the bid offer for mini or standard contract. The main difference is just the size of the contracts. Okay, so I'll just answer the first question earlier on the leverage and margin and example. So let's say I'm trading the mini contract. So just to recap, one mini lot is $10,000 notional value. So if I happen to want to buy this specific pair, right, meaning to say I'm buying euro dollar and shorting the US dollar, one lot here will mean that it's 10,000, buying or selling 10,000 euro. To know the margin requirement, right, you can actually go into this info tab, just expand on margin requirements. You see this particular box here, it says the deposit factor is 5%. So 5%, what it actually means is that the margin required is 5%, and margin required 5% is based on the base currency, which is the front currency. So it's 5% for this particular pair, right? Which means it's 5% of 10,000 euro dollars. Okay, euro, 10,000 euro. So over here, it will translate 5%. There is a calculation here. It translates to about $700 Singapore dollars. So that's 5%. Okay. So to enter this trade, right, of one mini lot, which is 10,000 euro dollars, okay, EUR, we don't need to come up with the full amount. What we need is just $700 Singapore dollars as a deposit, or we term it as a margin requirement or initial margin. We need $700 to enter to have an exposure of one mini lot. Okay, so that's what I mean earlier. Okay, I hope this better explains the concept. So the other question earlier was on the exchange rate. Okay, so when we look at the profit and loss for this particular pair, because if you notice, this is a Singapore demo account, and the denomination, currency denomination for this trading account is in Singapore dollars. So for this particular pair, right, the euro dollar, right, the profits and loss is actually in US dollars. If you recap our previous example, the profit and loss is always the counter currency. So if let's say this trade you happen to make 100 US dollars, right? Upon closing the trade, right, we will convert this $100 to Singapore dollars and apply it to your account balance. So of course, conversely, if this 100 US dollars is a loss, then we convert it to Singapore dollars and deduct it from your trading account. So your trading account is always in SGD. Okay, so the trade could be denominated in another currency, but we only do the conversion upon you closing the trade. Okay, so when you close the trade, that's when you realize your profits or you realize your loss, and that's where the physical conversion happens. Okay, so don't worry too much on the conversion. Just take note that if it's a Singapore dollars account, everything will be denominated eventually to Singapore dollars. Okay, so let me see any other questions. Okay, for overnight FX position, additional charges. Okay, good question. So for FX, right, there is this thing called swap. Okay, so swap is basically meaning to say that if you are holding an FX trade past the trading day, right, there is actually interest charges. So remember when we talk about FX trading, when we buy or sell a pair, we are actually buying one side of the currency and selling the opposite side. So swap happens because there is an interest rates differential. So for example, the for euro dollar, right, there is an interest rate, right? For US dollars, there is another set of interest rate. So if there is an interest rate difference, right, and you hold the position overnight, right, what it means is that you will receive interest for the currency that you are long, and you will be paying interest for the currency that you're short. So if you're buying this particular pair, right, meaning to say you are buying euro dollar and selling the US dollar, so you will receive interest for euro dollar and you will pay interest for US dollars. So if there is an interest rate difference, then it comes to you will need to pay a swap. This swap is not chargeable if you're trading intraday, meaning to say if you enter your trade and exit the trade within the same trading day, then you will not incur this additional overnight holding fee. But if you are not exiting it in the same day, then there are charges as well. So of course, even if you know that both interest rate are the same, right? Let's say at 3%, right? There is some form of a cost to you as well, because the brokers, every broker, when they are charging their overnight, right, there's some form of a markup over there. Okay, so even when we get all these prices from the liquidity providers or the banks themselves, right, there is also a markup already. So more often than not, you'll realize that the if you're holding position overnight, it is more often than not a cost to you than a profit, unless you are trading in a high yielding interest currency and you are probably shorting low yielding currency, like maybe the yen, right? So the yen is probably is usually 0% or even negative interest. So if you are shorting yen, you don't have to pay a lot of interest. The borrowing cost is very cheap. And what people call this is they term it as like a carry trade. So what you're trying to do is not so much to profit from the exchange rate difference. You are trying to profit from the interest rate difference. So you're borrowing a currency that is very low cost of borrowing to buy currencies that has to get a better rate. So that's what we call by a carry trade. But in the recent few years, it has been a low interest rate environment until recent times, right, when we start to see the Fed hiking interest rates. So we could see more of a kind of a carry trade kind of strategy coming back. But just take note that more often than not, it is usually a cost to you. Okay. So another question is, hi, will there be a repeat? Mr. Pai hasn't visited. Okay, yes. So this will be a recorded session. We actually upload it on our academy as well and on our YouTube. So if you are keen to revisit again on this webinar, just look out for our YouTube channel. You can just YouTube IG Singapore and subscribe to us as well to get more of the educational content. Okay, so let me see. Okay, it's 8:30 now. Just let me see if there's a last few questions that I can take. Okay, when there is a currency conversion, where can we find the exchange rate? Okay, so the exchange rate we are using is usually the spot rate, which is this rate. Um, so example, let's say if you are a Singapore dollars account, right, and then you are trading in a US denominated contract. So right now what you're doing is you are selling USD and buying Sing, right? So we look at the sell over here. This is the rate we are using. But of course, this is not the real rate because for conversions, there are costs as well. So to be very frank with you, the cost is 0.5%. We mark up 0.5% on top of this rate when we do conversions. Okay, so I hope that answers your questions. Let me see if there is any other questions. Okay, I think that's all the questions that I have for today. So thanks for staying throughout. But before we leave, right, can I just trouble you guys to do this 1 minute feedback form? I'll just flash it over here. Okay, so I'll appreciate if you can take 1 minute of your time to scan this QR code to fill up this a survey or feedback for myself as well as for us to determine how what kind of content you're looking at and how we can better or further refine our content so we can bring more value to you as well. So I'll just leave this here for the last minute and I'll see if there's any other questions. Yeah, I'll just leave this here. So please help me to complete this survey so we can also bring better content to you. Okay, what is the trading hour? Okay, so another question we have is the trading Singapore trading hour so for us, right, we actually use 10 p.m. UK timing to calculate overnight charges. So 10 p.m. UK time is about 5 a.m. Singapore time or 6 a.m. depending on whether there is daylight savings or not. So yeah, so that's that. So just take note that if you are entering a trade, right, and you didn't exit the trade before 5 a.m. or 6 a.m. Singapore timing, then you will have to pay for the overnight funding. But to be very frank with you, if you are not looking at very long term, this overnight funding shouldn't be a cost that is too significant and you shouldn't be too concerned with, unless you are saying that you're gonna hold this trade for a few months or even years, then yes, then it will be very significant. But if you're looking for shorter term trades, right, then it shouldn't be too significant. All right, so that's that. Okay, I don't see any other questions. So thanks everyone. I think most of you stayed all the way till the end for this last 1.5 hours with me on Forex trading. I hope that the session has been of value and of use to you to help you to get started in FX trading. If you have any questions, right, just feel free to drop us a call. And if you're new to IG, we also have this dedicated team, the new business team, who will be able to guide you and help you as well in terms of, if you have questions on the product, you have questions on the trading platform. And for existing clients, right, if you're trading other products and you're new to FX trading, yeah, don't hesitate to drop our client servicing desk a call as well if you encounter any issues. we'll be very happy to help you to get started as well to trade, different products if you're looking to explore into FX. Okay, with that, I think I've exceeded today's webinar by about 5 minutes. I thank everyone again for joining me all the way till now, and enjoy the rest of your night. Thanks again, and I'll see you guys for the upcoming webinars as well. All right, cheers, bye everyone.